Hey everyone, Brian Lahr, One Life Financial Group. Stocks maintain momentum at year's halfway point was the title of Dimensional's recent mid-year market review. In today's video, I'm going to review this information after discussing three different takeaways from the first half of 2024. Number one, U.S. stocks extended a bull market with the S&P reaching a series of record highs in the first half of the year, led by technology stocks. Number two, core inflation fell slightly, but it remained above 3% in the U.S. The Fed kept rates steady while central banks in Europe and Canada cut the interest rates. And the third, small cap and value stocks lagged the market while high profitability stocks outperformed. A reminder of the benefits of pursuing multiple premiums of higher expected return. So let's dive into the details. The beginning of 24 started a lot like the end of 23 with markets rising amid a talk of a potential decrease in U.S. inflation and interest rate cuts from the Federal Reserve that could follow. But much like last year, those expectations remained unfulfilled as core inflation fell slightly but held above that 3%, and the Fed stood pat on interest rates. U.S. stocks, as measured by the S&P 500, rose to a series of record highs, as you might have noticed, in the first year's half, and the benchmark 10-year U.S. Treasury bond yield approached 5% in the spring before retreating. The Fed held a key measure, the federal funds rate, steady through June at 5.25%, the highest level in more than 2 decades, with officials citing an effort to cool persistently high inflation. Meanwhile, the European Central Bank cut rates for the first time since 2019, as did the Bank of Canada. U.S. core inflation was 3.4% in May, a multi-year low, but still well above the Fed's 2% target. However, it has moved in the direction policymakers have said they'd like to see it go, lower, though they indicated at their meeting in June that they expect just one rate cut before the end of the year. Against this backdrop, U.S. stocks extended a bull market that began late in 2022, with the S&P index gaining 14.6% through June 14th and notching new all-time highs. Record levels may lead some investors to wonder whether it's a good time to sell, but historical data could help allay such concerns. Periodic record setting in the market should be expected for an asset class with positive expected returns. As Exhibit 1 shows on the screen, the average return for weeks following these new highs was 0.26%, which is very close to the average return of 0.22% across all weeks. As long as investors demand positive returns in exchange for holding those stocks, a new market high doesn't mean that the market's going to tumble. The strong rally in technology sector in 23 continued into the new year. The tech-heavy NASDAQ, after gaining 44.6% last year, has risen 18.1% this year versus the S&P's 14.6% gain. NVIDIA remained the biggest driver of gains in the tech sector through the end of May, as demand remains strong for chips using to power cutting-edge AI applications. But expecting NVIDIA and the rest of the so-called Magnificent Seven tech stocks to outperform the broader market is to bet on them further exceeding the market's expectations. Simply meeting expectations may result in returns more in line with the market, consistent with the history of the top U.S. stocks. Global markets reached multi-year highs, with the MSCI All-Country World Index rising 10.6% through mid-June. Developed international stocks, as represented by the MSCI World ex-USA Index, added 4.4%, and emerging market stocks, as represented by the MSCI Emerging Markets Index, were up 6.4%. U.S. Treasuries were a little unchanged for the year, with the 10-year Treasury bond falling 1%. However, yields, which rise when prices fall, remained higher than they have been for most of the past decade. The 10-year Treasury yield touched 4.7% in April, after nearly reaching 5% last October for the first time since 2007, before pulling back to 4.2%. And if we try to put premiums in perspective, as the broader market gained, value stocks and stocks of companies with smaller market capitalizations were just unable to keep up with their historical outperformance. The MSCI All-Country World Value Index rose 5.3%, about a third of the 15.7% increase for the MSCI All-Country World Growth Index. Without help from the U.S. tech sector, the MSCI All Country World ex-USA Growth Index only rose 6.4%, still ahead of the 3.5% increase for the MSCI All Country World ex-USA Value Index. Small cap companies underperformed large caps. Stocks globally, the MSCI All Country World Small Cap Index returned 1.3% versus 10.6% for the larger cap MSCI All Country World Index. But history suggests giving up on small cap value after prolonged stretches of underperformance in the past would have been a mistake. And premiums don't always move in lockstep, as stocks of companies with high profitability have recently outperformed the stocks of companies with low profitability. That has held true in both developed and emerging markets this year. The FAMA French Developed High Profitability Index rose 10.7% as of May 31st versus 6.8% for its low profitability counterpart. The FAMA French Emerging Markets High Profitability Index rose 5.4%, while its low profitability counterpart rose 0.7% as of May 31st. It's a reminder that investors who pursue multiple premiums can increase their chances of long-term success. So the benefits of a flexible approach, pursuing historical premiums, is just one way of seeking to outperform benchmark returns. Implementation, including a portfolio's design, daily management, and trading, is another. Every June, an event helps put this into focus. That's when the Russell US indices undergo their reconstitution, when the benchmarks add and drop stocks. As time goes by, however, stock prices will change. What was once a small cap stock might become a large cap stock. Revising holdings annually means those stocks are stuck in the index, regardless of their characteristics, until the following June. As Exhibit 2 shows, from December 2009 to May 2024, the small cap Russell 2000 index had unsteady exposure to small caps. The percentage made up of large caps tended to rise throughout the year and peak before the index was reconstituted in June. That exposure to large caps came at the expense of a more consistent focus on small caps. In other words, investors may not have been getting what they came for. An investment process with flexibility to evaluate and adjust holdings daily can provide a more consistent focus over time, potentially capturing premiums more reliably. Investors who diversify and focus on those premiums and embrace a flexible investing approach will still confront uncertainties in the year's second half. But uncertainty is unavoidable, and it accounts for the risk that can lead to positive returns over the long haul. How long can this bull market endure? And which way is inflation going to go? Which way will interest rates go? Will the surge for those AI-associated companies continue? Will global hostilities in the Middle East and Ukraine ease or increase? Will the U.S. election bring a big November stock swing? Spoiler alert, it usually has not. So we'll find out eventually, but by the time the answers are also are found, they're also going to be incorporated into the market prices. And until then, 2024, like every year, is a good one to have a long-term plan and consider sticking with it. It was great to see you today, and we'll see you soon.